Hey everyone, I'm Mark Goucher and welcome to another video of Simplicity Investment Watch. Today is Tuesday, January 28th, 2025. So the major markets are very choppy over the last week or two with big swings up and down and lots of gaps going from day to day, which I'll show you on the charts. And these gaps are, much more than typical. An occasional gap from the close of one day to the open of the others. It does happen on occasion, but there have, as you'll see on the chart, there have been just a whole entire more than a week of them to show. So it's making the situation very volatile. Trump says one thing and the market jumps. Trump says another thing and the market jumps the other way. And the only certainty for now is really the uncertainty. Consider that when you're placing your trades, and particularly the size of the trade and the amount of reasonable risk that you're taking. All right, before we get into the major market action, let's go over our disclosure. We do not give financial advice, and this information is not for investment decisions. This is for educational purposes. The stock market is risky, and any trade or investment is expected to have some or total loss. The use of derivatives increases investment risk or potential loss. Do your own research before any trade. Please consult a financial advisor or professional to determine what is a suitable investment profile for you, given your investment goals and objectives. All right, let's start with a look at SPY, the ETF for the S&P 500. And as I was saying in the opening, you can just see these gaps from day to day. Typically, I mean, obviously over here is more what's typical. It's just that the candles just move in a pattern upwards. Not often is there a gap. There's a gap right there, but and obviously this is a significant gap. But there's just been a lot of them from January 13th, which is 2 weeks ago. Gap, 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 gap up, gap down, and gap up. So very volatile, as I was saying. That said, SPY still looks strong on for the technicals using my lucky 13 indicators here. There's the trend is up, which is what this ADR is telling me. Excuse me. Yeah, the trend is up right here. The green is above the red. On MACD, it may be fading somewhat, but still it's positive. RSI is positive on the plus over 50. The Chaikin money flow indicator right here is in the green, and RRG, so rotational graph, is showing the momentum is starting to turn to the upside, which is followed by the relative strength ratio, this other line here. So that is turning positive. And so overall, it's a good score. And although there is risk in the volatility, the overall markets are still showing strength that this uptrend should continue. So it's a little bit of a mixed message in terms of, yeah, the tide's high or coming in, but there are some rough waters. So just be careful with that. So the Nasdaq, or in this case the ETF QQQ, is very, 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 very similar picture. A lot of gaps moving up over the last 2 weeks. Gap down, gap up. Very, very similar to the S&P 500. And on the Lucky 13 score, for my technicals, not as strong as S&P, but still good. This does show a downtrend. This is MACD's fading a little more than what we're seeing on the S&P 500. Excuse me, RSI is a little bit less. So again, it's not as high a score as SPY, but it is still in the bull market territory. So same words of wisdom on QQQ as SPY is that yes, the tide is coming in or the tide is high, but the waters are also a little rough at the same time. And DIA for the Dow Jones Industrial, I mean this was the one that was just taking a beating over the what since December, right? All this was going on, and SPY and Nasdaq were basically moving up or showing more gains, whereas DIA was just continually taking a hit. And now this has just moved nicely. I mean some significant gaps here, but it's just continued to move up. So I'd imagine lucky 13 score is, yeah, so the lucky 13 score, the scoring of the technicals here are stronger than the SPY and QQQ. Definitely have an uptrend, fairly strong uptrend. MACD is very strong, RSI is very strong, checking money flow is strong, and momentum and ratio for rotational graph is positive, and so there's a lot of strength in the Dow Jones Industrial. So overall, just exercise caution with the new positions. You keep your position size small, the stops tight, or a stronger you have a stronger consideration about for using the collar strategy instead of stops. I've talked about this in a previous video, and I have it up here for you. So this is Google today, closed at 197.7. And just to demonstrate the collar, and actually Google's on my list today for action lists. So if I were to go long Google in the morning, provided that it opens up positive, I would only buy it if it's positive or moving positive in the first 30 minutes. But let's assume it does, and it's a buy. So the covered call strategy would be that you sell a call, and this call is roughly about 6 or 7% above the current market price. So I know that if it gets called away from me, I'm getting 6 or 7% in stock appreciation plus whatever I get for selling that call. I get paid for selling that call. Now, on the other side, on the downside of that, once you sell that call and whatever you get for it, say you get $2 for that call, times 100 is $200 if because the options are in lots of 100. So you bought 100 shares, you sold one call for $200, and I don't even know if that's the actual numbers, but just use that for an example. Then you would say, okay, the market's a little choppy. I want to buy some protection and protect myself from the downside at the same time. So you use your $200 that you got from the call and you go out there and you buy a put. And what the put does is if this price action goes down below this 180 level, which basically gives you downside of 7 or 8%, if that moves down below that 180 level, instead of a stop, which means that it's going to automatically sell on you because you put a stop loss into the system, the buying the put gives you the opportunity to not sell it at 180 if it just moves through that area quickly and then moves back up. So the put means, obviously, for those who don't know, you can put that to somebody else. Say this puts at 180. If this stock goes from the 197 that it is today down to the 180 in the time that this option contract is active, depending on what date you buy it for, say February 7, February 14, 21st, whatever Friday, or even months down the road, if that happens and the stock falls all the way down to 170, you're protected at 180. You can put it to somebody else at 180. Somebody has to buy that from you at 180, whether they like it or not, because somebody bought that contract and that's what their obligation is to take it in at 180. So you are protected at 180 no matter what. So this is a caller. You sell the call. You're hoping that it goes up. It's a bullish strategy. So You want to make your money on selling the call. You want to make your money on getting getting Google called away from you. If Google doesn't get called away from you and Google just moves sideways, this call expires worthless. You get to keep the premium you got from that, and you still have this protection down below. These two, you probably want to get them for the same date. Say if you bought you sell this call for February 7th, you want this insurance in place until February 7th. Once those contracts expire and you still own Google because it hasn't gone above this price and it hasn't gone below this price, it's moved in between or maybe moved slightly up. You just do that all over again. So that's the collar, and that's something to consider in this market. All right, major economic news coming up for the balance of the week. So starting tomorrow, the 29th, there are other economic releases during the week. I've only highlighted the ones that are considered the majors. And so tomorrow at 10:30 is crude oil inventory. That is an inflationary sign or indicator. And of course, the big news is tomorrow at 2 o'clock is the federal funds rate comes out. It's expected to just hold steady at 4.5, and then it'll be followed by a statement by the FOMC. And also a press conference at 2:30. So that'll be a lot of, depending on, as you well know, every single word will be dissected and interpreted any way that the market sees fit to move in one direction or the other. So words can be volatile or cause volatility here. So just be aware of that tomorrow. Another reason to maybe take a pause. Wait for all that to happen. On Thursday, there's advanced GDP, unemployment claims, also big movers usually. And then pending home sales later in the day on Thursday. And then finally on Friday is the core PCE price index. This is a pretty major one by the Fed. They like to follow that one. So that's something to keep an eye on as to whether or how the market reacts to what numbers get released. The forecast is for 0.2, as you can see right there. And that is so there is a fair amount of news coming out this week. And this all, besides whatever Trump says one way or the other, this all could add volatility to the markets depending on how these numbers come out and what the Fed says tomorrow. So I've cleaned out a lot of my buy list. Some of it's just been on there for a long time. And just to kind of trace back to like my first opening video where I described my strategy or how I screen or find stocks that I would be interested in for a swing trade. My strategy has always been centered around trending stocks, trending up or down, and that are in a period of consolidation. So they're trending and then they come into consolidation. I find that consolidation by using the TTM indicator, which again I explained in my opening video for those who are interested. And then I take an appropriate position, whether it's bullish or bearish. I take an appropriate position when they fire, as the expression is, it fires out of TTM consolidation. So once it's considered out of consolidation, it's said to have fired. Now, consolidation basically is the Bollinger Bands consolidate within the Keltner Bands. The Bollinger Bands are based on standard deviation from a mean, whereas the Keltner channel bands are calculated off of average true range of a stock. So when you get the standard deviation consolidating within ATR bands, that is truly a compression or consolidation area of lower volatility, and very common when stocks are moving up in a trend or even down in a trend, that nothing moves in a straight line, so it'll move 10, 20%, what have you, and then consolidate 3-5%, whether it's consolidated up or consolidated down. But the point is to catch that in its consolidation phase, or when it comes out of that consolidation phase, and and you confirm that it is continuing the trend that it was in before that consolidation trade. So an uptrend is continuing to be an uptrend, and your downtrend continues to be a downtrend. Don't try to jump ahead of it and guess it. It's in an uptrend, it gets a consolidation. Okay, oh, I'm going to take a position ahead of this, and because when it continues to go up, I'm gonna be there for it to make so I don't miss out on a single penny. But you're guessing. It could go into consolidation and just turn around and go the other direction, whether it's in an uptrend or downtrend. So take note of that. All that said, what you now see on the list are stocks that meet my screen criteria and have fired within the last few days. I have dates next to them. So basically since last Friday, my screens that are run daily, my screens for Friday, Monday, and today being Tuesday the 28th, these are basically the ones that have fired within the last few days. So basically they just began their move back up for the bullish trend and continue down for the bearish trend. So so I have straight up, I have Google, Reddit, TWLO that all have fired within the last few days. And they have been in an uptrend and they're continuing their bullish trend. So you can take bullish action against those. And then the bear list ad that I put on is Super Microcomputer. That has been in a significant downtrend, and it went into some consolidation. I'll show you on a chart, and it has continued its bearish trend. So you can take a bearish option strategy against that. So first we have Google that's on the list. This is the TTM indicator down here. It went into consolidation. It fired for one day, basically meaning that the Bollinger Bands got outside of the Keltner channels, and then it consolidated back in. So I have set an anchored VWAP on the last earnings day. Buyers are in charge since the last earnings report. Next earnings report is coming up February 4th, so be careful. That's next week. I'm not saying I never, but I'm a little more cautious about taking a options position through an earnings report that can cause a lot of surprises or volatility. And I also set an anchored VWAP off this high, which was, what day is that? That's the 24th, so last Friday. That high is last Friday. But what's to note here is all of these shadows or wicks gone up and pushed back, and then it moved sideways, and it tried to go up and it got pushed back, and it tried to go up and it pushed back. So this zone up here, you have resistance, and I really would look to take a position on this, well, probably after earnings season. After earnings report, but particularly if this can prove to me that it can get through this price point, which basically is somewhere around the 203 range, right? So that's something to watch for. And again, it is on my list because it fired, but it fired on Friday, and then it went right back into consolidation Monday, Tuesday. So technically, this really isn't fired, and I probably should have just put it on hold for the moment. So I'll take that all back. But that's what to watch for on Google is that 203 price is sensitive. If it can break through there with some meaningful volume, this is probably a very good strategy to throw on your covered call. Your call is your caller, which is your put on top of your covered call, or some kind of like bull put spread where you're selling a put and then buying another put to protect yourself down below. I'll explain that in a minute. But that's the story with Google for right now. TWLO's on my list, and this one just 5.74% today. And this is after this gap right here up. That was 20% gap. Wow, that's incredible. And what day was that? That was last Friday. So it popped last Friday, as you can see. And I put an anchored VWAP on that. I also put the anchored VWAP on the last earnings, which I typically do. Buyers are very much in charge. There is an earnings report coming up February 13, a couple weeks away. That's a little more time, so you have time to play some option strategy against this. But this is definitely a green light. Go long the stock, sell a call against it, or again now because of the volatility factor that this has moved so much. And this line down here is my average true range, my ATR, and my ATR has spiked. So the ATR spiking tells you volatility is up, and when volatility is up, that's the better time to sell something rather than buy something. So you want to sell, you want to come up with some kind of strategy where you're selling a put against this. So the best way to do that is to sell, sell an option against this, and the best way to do that is to sell a put against this. And I'll show you the options table for this as to what might be a good pick on this based on its true range ATR. And the last of my bullish picks is Reddit came up on my list within the last 3 days. Another story very similar to what you're seeing with the others. On the last earnings was on October 29th. Buyers have been absolutely in charge since then. And I put another anchored VWAP on this low, which sometimes I'll do if it has a little pullback, making sure that the movement from that pullback is on the buy side, which this has shown that it is. And it went into consolidation back for several weeks here. This goes back to January, almost for a month. There was this consolidation right in this area here. In any case, it has popped as of today, and I would another strategy where you can go long the stock and sell the call, so covered call. If you want to put some insurance on that, use the premium that you get from your call to go off and pay for a put that's safely down below it, whatever you're considering a reasonable loss, so to speak, and whether you want to only take a 5% loss or a 10% loss, but find a put at that price range, do the math, whatever it comes out to for you. So that's your caller, and then the other strategies. And again, this is another one where this is the ATR line, and since November, the volatility has just absolutely spiked. So the ATR is $11.19. So what that means is your average true range is $11.19 over the last 14 days. It's an ATR 14-day period or 14 candle period, whatever chart you're looking at, whether you're looking at a intraday chart or a daily chart, monthly chart, whatever, it's 14 candles. In this case, it is 14 days. But what that tells you that you need to know that if the stock is at 194.75 right now, that tomorrow this could move $11.19 and be within acceptable range for its behavior over the last 14 days. Now, it could move $6 up and $5 down, and that's the range that it's moving in. But just be aware it has that type of movement. So when you're looking to put a stop on this or to figure out where to sell that call, if you look at that ATR, you got to set it at least $11 away from it because it can move $11 in a day based on its recent behavior over the last 14. So this is volatile, and but when it is volatile, the premiums go up on that for the options. That volatility is a component that goes into the Black-Scholes model for the calculation of the options. So that's also a good thing. Just so happens when I looked at Reddit for strategies, despite what I just said, there wasn't as much value as there was in Google and TWLO. So I really didn't see the kind of value that I like to see if I want to take a strategy against this. The strategy in particular that I was looking to take was a bull put spread on this one, and I'll show you the options chart in just a second here. The bear strategy that's come up as fired off of TTM. So this green is right here is fired. So it was in consolidation, and then today it fired. So it moved out, the Bollinger Bands moved outside of the Keltner channels. So this has obviously been in a downtrend, well, since March last year. Just an ugly chart. This is a death cross, 50-day average crosses below its 200. So this is death cross. So this is just all sides, all signs down, 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 down. So this is a strategy to take this opportunity to take a bearish strategy against it. And in this case, the value, when I looked at the options on this, is in a bear call spread, which I will show you the options chart. But basically, the bear call spread looks like this. So your stock is 28.18 at the close of today, and all signs are down on this thing, right? So, okay, how can I make money on this? So obviously you can short the stock. Not all can do that, nor is that really what I would recommend. But another strategy here is I think it's going down. So what I can do is I can sell a call, which means someone can call it from me at a price above it. And what price you pick is, you have to look at the options chart. You want to pick a delta that's below 30, and I'll show you what that means. But basically, delta is also another interpretation of the odds of it landing in the money, right? So if I have something, a delta of 30, the probability of it landing in the money is like 30%, which is pretty small, right? It's 70% chance that it's going to be out of the money. So I sell that call. I get paid for that call. Remember that. You're selling the call, you get paid for it. I think it's going down. So this call, no one's ever going to call it for me if this thing goes down. But market is what it is. If it goes up, you think it's going down, but it just goes totally opposite on you. Someone can call it from you at that price. Say that's $32, just for the sake of this conversation. I'm going to buy another call to protect myself. I'm going to usually buy that other call within $5 of this price. So if this was 32, I'm buying a call at 37, within 5 points. What happens that way is that someone can call it for me at 32, say the price goes way up to 40. They're going to call it for me at 32, of course, because they could buy it from you at 32. You have to give it up at 32. But you buy the call because you don't actually own the stock. So now you're on the hook for buying the stock at 32, or excuse me, you have to buy it at the market, sell it at 32. So what you can do to protect yourself on that is that you can buy a call instead. And what happens is that call makes this call basically a wash, right? So if I have one call here and one call here, someone's calling it away from you, but now you can buy it at this price, and just it washes out the call that you sold. Your risk is the price differential between these two. I try to keep it at $5 or under. So what that means is $5 in the stock price on an option contract is 100 shares, right? So that's $500 that's at risk, but you are getting a premium for selling this call. I don't know what the price is, but say it's $1.25. So you're getting $125 for selling that call. So what does that math come out to be real quick? Your 500 minus your 125 is 375 is actually at risk. So you're making 125 when you sell that call, but you're risking 375. That's not a bad trade-off. Most of you would, if I told you, hey, would you buy something for 375 with the potential to make a 50% gain or a 30% gain in, say, a week or two? Most of you are going to say yes. I am going to say yes. So this is basically a bear call spread. It's a vertical spread, and you're making money because you're selling the call. You're going to get more money for this call than it costs you to buy this call. So your true net profit out of this, so to speak, or at least the premium you get at first, is the difference between these two these two premiums on these two different strikes. But that's how you set that up. You know your risk going in. That's the beautiful thing about it. You know your maximum gain is what you're going to get for this call. You know your loss, your maximum loss is what I just explained, the differential between the two strike prices, less what you got paid for it. So everything's defined going into the trade, which is a beautiful thing about options. Like when you buy a stock, you can put stop losses in and take profits and what have you, but this just sets the parameters up, and you know the math ahead of time, and you know what you're getting into. So it's one of the reasons I really enjoy working with options, because everything's kind of spelled out for me right from the get-go, and you know what you're getting into, you know your risk, you know basically what you're dealing with. The only other note on this is placing any trade is that earnings is Thursday, so be careful about that. A really, really good earnings report obviously could cause this thing to exactly do what that green arrow is. So maybe it's something you want to wait till Friday to implement, or maybe after the earnings report. The double-edged sword of that is you're going to wish you were in it. If the earnings report is bad, you're going to wish you were in it, because if that goes down a lot, it's great. You got your call, you made your money on your call, and it's a win strategy. So, but the earnings report can create some uncertainty, just to be aware of that. All right. These are the covered call considerations for the stocks that are on my buy list right now. So Reddit, Google, and TWLO. The best deal right now, so to speak, for February 7 contract, which is a week from Friday, you can buy 100 shares of Reddit and at 194.75 and sell an options contract against it, a call against it for at the 205 strike. If it gets called away from you at 205, it's a 5.26% gain. That's a 2.4% return just on the premium you're going to get for selling that call. You get that right away. If Reddit never hits the 205, you get to keep your 2.4% or your $465 right here. You get to keep your $465, and you can do it all over again. If it gets called away from you, okay, great. You're looking, I don't know, about a 7.8% return between your premium on the call that you sold plus the appreciation in the stock, selling it off at 205. So that's one of the best deals out there right now. There are some other decent ones here. Google, same thing, February 7 contract. Google's at 197.07. The strike's 207.50. Same kind of deal, 5.29%. You're going to get $325 for selling one contract against 100 shares that you might own, or the 100 shares that you're going to buy if you do that. And it's a 1.7% return. If it gets called away from you, you're looking at about a 7.1% return total between price appreciation and the premium you get on it. So there's that, and then so on and so forth down the list. Some pretty good value here for February 7th. A lot of one percenters. All right, so I just explained the bear call spread. This one right here for TWLO. TWLO, as I said, is on my list for popping out of TTM, and it has moved substantially. So I'm bullish on this. So with this spike in volatility, that's the time to sell because prices are up. So it's time to sell things, not buy an option, sell an option. So what's the strategy you can use? How can I sell an option and make money on this instead of buying? You can still buy the stock and do a covered call. That's fine. I mean, but another consideration here is you could sell put against this and buy a put against this. So you sell the put below the market price. Market price is way up here at top, 146.97. So you use your options chart to find that delta below 30, which I will show you how to, where they show that and how to figure out what that price is. But you find that option price and then you sell a put. So I'm getting paid for that. And someone can put it to me. That's my part of the deal. If I'm selling a put, someone can put that to me. Now, if this goes up in a bullish trend, I don't really care. They're not going to sell it to me, and that's fine. I make my premium, and everything's good. But in the event that this goes down, and these things happen, of course, I need some insurance to protect myself because someone can put that to me, and there's almost like infinite loss on this thing. And this thing can go all the way to zero in theory, right? But yet someone's gotta put it to me, which means I gotta buy it at that put price. Say that put price is 135, right? Which is right around somewhere in this range, right? So I gotta buy it at 135, and it's worthless. Say it went to zero, and that's catastrophic loss. So so your insurance here is you buy a put. Say you buy the put, let's just say you sold your put at 135 and you buy your put at 130, 5-point spread. So now I've got insurance on this. I will never be in the hole more than $5 on this stock, or for 100 shares, it'll be $500. But it's $500 less what I got paid for selling this put. So my real risk is something less than $500. And then your risk reward calculation is based on, okay, for something less than $500, say for the sake of this conversation, it's $400. I'm getting $100, just for an example, I'm getting $100 by selling the put, but my risk is $400. Again, the question comes, is that reasonable for me? Is taking a 25% gain, if I told you that you could buy something for $400 and put $400 at risk with the potential of getting $100 out of that, get a 25% gain in a week or two time, with your probability of success greater than 70%, again, I'd be in. So this is your bull put strategy, and I'm going to show you some option charts that basically help you kind of find out where do I want to sell my put at what price and what's the best value, and how do I ensure as best as possible that my probability is going to be at 70% or greater. So to find that put, this is a put chain for options chain for Reddit. I realize I was just talking about TWLO, but doesn't matter. The TWLO, your delta, you can set up your option chain to show you the delta. The delta is over here. Anything below 30 is what I'm looking for personally. So this tells me that the market is between 195 and 192. And so this is at the money. And that if I want less than 30 delta, I want to do a 182.50 or lower because I'm selling the put, right? So 182.50 or lower. The market's over here at 190 something, 193, whatever. I forgot what the price was for Reddit. But this is telling me that the market's at 193 roughly, and I'm selling a put at 182.50. So I'm going to get, based on this option chart, which is not live pricing, you'd have to find out what it is on Wednesday. I'm going to get $3.20, $320, because it's 100 shares to an option contract. I'm going to get $320 for selling that 182.50. Now, I just talked about your insurance. Someone can put that to you at 182.50, and if Reddit crashes and goes way down to $50 or zero, I don't want to be stuck at 182.50, so I need some insurance. I want to limit my losses to within $5, $5 or less. Some of these I can do $1, $2, $3. So your $5 spread right here means that I can go off and buy a put at 177.50 for 278. So the difference of these two is after getting paid $320 and then paying $278, you're going to end up with $42 for you. That's that's all. I mean, you don't necessarily own the stock. Well, not necessarily. You don't own the stock. You're getting paid $42 just for putting that position in place, and your risk is the $500 against the $42 that you're getting. Now, as I said earlier, Reddit really didn't have some positive numbers on this in terms of what I like to see for return. I typically like to see a return that is going to give me 20% or better. Even 30% is really what I'm looking for. But I'll look at some that are 20%. For Reddit, those numbers right there, risking $500 to get 42, and then actually you got to subtract the 42 from the 500, but risking that $400, it's not a good trade-off for me. Yeah, because the $42 you're getting against the 458 that you're risking, right? So it's the 500 minus what you're getting for the difference in the premiums here. That's only a 9% return. Now, 9% in a couple of weeks is nothing to like laugh at, which I'm laughing at. But so I got to kind of frame this properly. But for me, there are so many opportunities out there when you look at these spreads, and I'll show you some on the other ones, on the other my picks for this week. That are worth so much more. It's like that. I don't need to go for the 9%. I don't need to risk $42 to get, risk $468 or $458 to get the 42. So, but basically what I wanted to show in this was not so much that Reddit was the best example in terms of premium, but I just wanted to show you the delta. This is what you're looking for. This basically what this is telling you is that has about an 81% chance of landing in the money. Well, of course it is. It already is in the money, right? The money is at 193. That's at the market. Any puts at 217 are already in the money. And then as you get closer to the at the money line, you're going to get closer to 50-50 odds, right? 50-50 probability. And then you work your way down, and anything below 30 is basically what I'm looking for. So I just wanted to use this to demonstrate that first and foremost. All right, so for Google, so let's take that same strategy of a bull put spread on Google. Google's at 197.07. I already went off, and I didn't show it on here, but I went off, excuse me, and I looked at the delta. I looked at the options chain for February 7th, and I said, what delta is below 30? What's that strike price that I need? And the strike price I need is 187.50 or lower. So I've highlighted 187.50 or lower on this chart, this options filter. I use barcharts.com, shout out to them. So I'm able to create bull put spreads with both legs being shown for me, and all the math is being done for me. But what I focus on is my leg one, my first strike, the one you want to sell that is below the price. So just to show you for this chart, if I'm looking at a 187, I'm going to drag this down here. I'm going to sell a put because I think this thing's going up. I'm going to sell a put down here because my Delta 30 told me the 187.50 price is where I want to be. So that's the leg I want to sell. And then the other leg that I'm going to end up buying, which I'll go back to the chart, is you're going to buy one that's a little lower, 5 points lower, or whatever that filter was showing me. I don't even think that one was 5 points. Let's go take a look. Yeah, it was less than 5 points, so it's 187.50. So what this is telling me that, excuse me, I can go off tomorrow and obviously verify all these prices when the market opens and make sure this is the same good deal. But I can go and sell the 187.50 put, which is underneath Google's price right now. I'm going to get paid $315 for that. I will then buy for insurance. I will buy the 185, right? So now I'm only dealing with a 250 spread. So my risk is really only 250, but the risk is actually 250 less what you're getting paid for, um, the difference of these two, right? So it's 54 cents difference. They do the math for you right here when you do the screen. It's a 54. So I'm getting $54 for putting this on because I'm getting 315 for that. I'm paying 261 for that 185. That's my insurance. That's my protection, and I get $54. And then my max loss is that 250 less the 54. So I'm down to 196 on my max loss. So I know this is a well-defined strategy, right? I know I'm risking 196 to make 54 bucks. That's a 27.5% return all the way up to February 7th. And I don't even have to keep owning this to February 7th. I could get some value in this within the next couple of days if the price goes up. And say I get a 10 or 15% gain, I can just close out this whole thing. I don't have to wait till February 7th. If I sold the 187.50, I'll buy it back, and I bought the 185. I'll sell the 185. Of course, you got to do the math at the time of that to make sure that that there's profit in that, but because you wouldn't do it otherwise. But this is what I'm looking at. So this is a very good bull put spread for Google right at the moment. And again, I would double check the math in the morning if I were going to put this on. And then the one for TWLO, same thing. I went out and I found, okay, I said, all right, for puts, what are the ones that are at below Delta 30? And it told me for February 7th, you want a price at 141 or lower. So I said, okay, great. I ran the filter through barcharts.com to show me bull put spreads, and I focused on the 141 first strike, the first leg at 141, so I could sell the 141. And my best value when I looked at all of these, some of these are kind of, I hate to call them lame, but 7.9 is not a bad amount of money to make at all. But you got 22.7% here, right? So I said, okay, yeah, that's the one I want to do. 141. Sell that. I get $193. I'm going to turn around for insurance or protection. I'm going to buy the 139. So this is beautiful. This is only a $2 spread between the two, so it's $200 at risk. But it's $200 at risk less what you're getting for the difference between being paid the 193 to sell the 141 strike and having to buy the 139 strike at 156. So you're getting that $37, right? So I'm risking 200 less than 37. So I'm risking 163 to earn $37 in a few weeks' time, less than a few weeks' time. That's a 22.7% return with my profit probability at 71.2%. So the math is really strong on this. Nothing's for certain, of course, but that's why you got the insurance in there. You're protecting yourself. But you know your parameters going into it. You know what you're getting into your pocket right away. You know what your risk is, and no matter where this thing goes, you know I'm on the hook for $163 for every single contract. Now you can leg into this and go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 contracts depending on the size of your account, and that's more common, right? Just multiply everything by 10, right? So $370 to risk $1,630, maybe more palpable to you because that's okay. Those are larger numbers. I like that. I like the fact that I can make $370 on this. So with 10 contracts, and it's just whatever your account can support. But always know that you know your max loss, therefore you know what your broker is going to require for you to have in the account because you got to cover it, and it's very well defined. So one of the positive features of options. And this last one is for SMCI. I basically I told that's a bear. This is a bear strategy, so I was looking to do a bear call spread. Same thing. I went over to the options chart for February 7th. I looked at the calls. I looked at the calls that had a delta just under 30, and the stocks at 28.18, and it was telling me that the delta that the price that I want to look at for that kind of delta is 33.50 or above, right? Because remember, I'm thinking this is going down, so I want to sell something that's above it because I don't think it's going to go up there. I think it's going down. So 33.50 or above. The best value was this 19. Again, it's getting on the low end of what I typically like to risk, in terms of this. I like to get above 20 and definitely absolutely above 30. I'm in, but this is not a bad scenario here. So I can sell the February 7th contract at 33.50, get $110. I'm going to protect myself by buying the 34.50. That's a $1 risk right there. That's $100 on 100 shares, right? So that's nice. 34.50. I got to pay 94 cents for that. So I get 16 cents out of the transaction. $16 times 100, and I'm risking $84. Not bad for the time frame, and that comes out to that 19.5 with the 76.4% profit probability. So that's the bear strategy on SMCI. All right, I realize this video was longer. I did go over a lot, but I've been meaning for the longest time to explain those vertical spreads, that the bear call and the bull put. So thanks for watching, and I appreciate your time and your interest in this. If you have questions or you need to reach me, my email is mark@simplicityIW.com. And once again, thank you for your interest and your time. Please click on subscribe. And remember, keeping things simple is really smart. All right. Have a great one. Take care, everyone. Good night.